Now joined by Director and Chief Economist at Econometrix, Dr. Azar Jammine, and he joins us via our video link. Dr. Jammine, thank you so much for your time this evening here in SABC News. I mean, many have predicted that we should expect an unchanged repo rate. What are your predictions?
I think it's virtually certain that we will have an unchanged repo rate decision on Wednesday. There's no question that there was a little bit of disappointment last week with the news of a rise in the CPI inflation rate from 5.3% in January to 5.6% in February. This was slightly higher than had been anticipated. More ominously, even if you exclude the impact of fuel and food prices, the inflation rate, the so-called core inflation rate, went up from 4.6% to 5.0%. Now, the Reserve Bank implicitly is pursuing a target of 4.5%. That is the midpoint between 3% and 6% of the official inflation target. But they've been intimating for some time now that they're really focusing on the midpoint rather than looking at the range. The fact that that 5.6% is still within the range of 3 to 6% is reason to believe they won't raise interest rates as a result of this bigger than expected inflation figure. But the fact is that at 5.6%, it's still way above the 4.5% level that the Reserve Bank is really targeting. And so they will not cut interest rates in a hurry and will only cut interest rates later in the year when they are actually convinced that the inflation rate is actually declining back towards 4.5%. There are some who even suggest that there may not be any rate cut next in the second half of the year. But at the same time, one recognizes that the economy is weak. January retail sales growth was extremely weak. Credit demand is very low. And overall economic growth remains quite weak. And over and above that, there is hope that internationally we're going to see a few rate cuts in the second half of the year. The moment the Americans and the Brits start cutting interest rates, there's no question that the domestic Reserve Bank will have greater scope to reduce interest rates here as well. But for the moment, no one is cutting interest rates other than the Swiss National Bank last week. And so it's a case of, yes, we all expect rates to come down later in the year, but not quite yet.
And when we speak about repo rates, we always speak about the consumers as well. And as you mentioned, inflation rising to 5.6 in January. What does it say for consumers, especially cash-strapped consumers who are hoping to see the repo rates, drop this year, as we're told many times last year that we can expect some sort of relief come this year?
Yes, undoubtedly, consumers have been hoping for some relief later this year. In fact, today we saw the BR Consumer Confidence Index rising somewhat, especially the expected confidence component of that measure. And that was largely because of this expectation that interest rates will indeed start coming down later in the year. Undoubtedly, consumers are taking strain, and today's figures suggested that it's the lower income groups that are taking even bigger strain than the upper income groups. And that is one of the reasons why the Reserve Bank is probably going to give way later in the year and reduce rates.
And talking about later this year...
Not quite yet.
Yeah. Talking about later this year, when it comes to seeing some sort of decrease when it comes to the repo rate, how certain are we that we might see it go down? What would be the contributing factors that you as economists have looked at that would suggest that we may see some sort of relief?
We can't be sure of that. Much will depend on vagaries such as fuel prices, which depend on international oil prices, and food prices, which depend on climatic conditions. And in both cases, they've unfortunately received a bit of a setback in the past month or two. The hope is that these will give way gradually towards the end of the year. And we're hoping that other elements of the environment will basically give way and allow inflation to fall sufficiently. Crucial is also what the exchange rate of the rand does. Even though the rand has been very weak, at around 19 rand to the dollar, it is very weak. But remember that it has been at that level now for almost a year. So on a year-on-year basis, the exchange rate hasn't deteriorated all that much, so as to cause import prices to rise unduly. They won't do so because the currency has been fairly stable.
Looking at, the expectations from the Reserve Bank that it may leave the repo rate unchanged, what does this also say about our economy? Our economy at the same time that's struggling to create jobs, the cost of living in this country. I mean, we just spoke a short while ago about inflation rising to 5.6%. What does it say about the state of South Africa's economy?
South Africa's economy has not been in a good state for the better part of a decade, and there has been very little improvement as yet. We know that the economy is struggling for a whole host of factors, structural weaknesses caused indirectly by corruption that has led to a deterioration in the state of our state-owned enterprises, and this has resulted in perennial load shedding, and more recently in logistical problems at South African ports and in our rail network that is just not transporting enough goods as it should be. Crime and corruption is still very, very prevalent. There is no way that lower interest rates will overcome these problems.
Yeah. All right.
And to try and resolve those problems through lower interest rates is really not attacking the fundamental cause of the lack of employment and low growth that we've been seeing.
Dr. Jammine, thank you so much for your time.